When you go to set up these types of plans, it's important to know that you do have, as the business owner or whoever's the official person in charge of this plan, you do have fiduciary responsibility. So if you can just take the approach of, this is my grandmother's money, I need to treat it respectfully and make good decisions on her behalf, and I need to have a slow decision-making process. I'm writing down why I'm doing what I'm doing and how I made the decision, what the process was. That type of approach will keep you out of trouble 9 times out of 10.
Well, hello and welcome to another guest interview here on the Profit with Law podcast. I'm your host, Moshe Amsel, and I'm excited about our conversation today because we're going to talk about something we don't talk about a lot, but here at my business, Profit with Law, Dream Builder Financial, our mission is to empower all people with wealth creation so that this and future generations can lead a better life. I'm going to let my team find a good podcast to link to in the show notes. So you look in the show notes below this episode, you'll find a link in the resources section to a previous podcast where I talk about where that mission statement comes from. But essentially, I started my business because I was inspired through an experience that I had from my grandfather. My grandfather left Nazi Germany, 11 years old, and ultimately ended up being a business owner, made some good financial moves, and took some of his wealth and helped all 36 of his grandchildren with the down payment on their first home purchase. And I want to help people with making that kind of impact on that future generation, whether it be your own children or grandchildren, whether it be philanthropically for charities that you want to support, or some other way that you get to leave your imprint. But this whole podcast about success in your law firm is really the jumping off point to success in your financial life. If you have a business that is throwing off gobs of cash, then you have the ability to take that money and use it to further increase your wealth or your net worth by savvy investing. And one of the things that happens when you start throwing off gobs of cash is, you start paying gobs of taxes. And we always want to think about what are some ways that we can minimize the sting of that. So one of the first places that us tax planners and advisors will tell you is, well, let's talk about what it might look like to set up some sort of retirement plan at work. We'll get some of that income sheltered and not included in your taxable income. And for that, we have an amazing guest today. Our guest, Courtenay Shipley, is the founder and chief planologist. Yes, that was a new word for me. If it's not a new word for you, then good for you. But I never heard it before. But essentially, a planologist is somebody who I guess works on the science of retirement planning. Chief Planologist of Retirement Planology, a consulting and registered investment advisory firm for corporate sponsored retirement plans. With a wealth of experience in the retirement plan industry, Courtenay not only offers her clients expertise in investment analysis, plan design, and employee education, but also helps them leverage their employee benefits in a way that supports their own business goals. She has worked with qualified retirement plans, developed strategies for third-party administrators, and conducted over 10,000 educational meetings. That's a lot of meetings. Courtenay holds various designations, including accredited investment fiduciary, chartered retirement plan specialist, certified plan fiduciary advisor, and certified exit planning advisor. She is also the esteemed president of the Retirement Advisory Council, and her outstanding contributions have earned her accolades such as Top Woman Advisor, Napa Young Gun, and FT Top 401 Advisor. Courtenay, welcome to the
Yes.
show.
Thank you so much.
It's an absolute pleasure having you here, and I really appreciate you giving about an hour of your time to share with our listeners, and we're going to try to make the best of it. But before we start, people are going to be like, okay, who is this Courtenay person? Give us the backstory. Tell us how you ended up on this podcast. I mean, like, how did you end up becoming a just some of that, something juicy there so we can connect with you, and then we'll jump into real conversation.
Sure thing. So this is my 23rd year in the business of helping people with having the luxury of deciding how they spend their time later in life. And I came straight out of college into retirement plans, believe it or not. I had a series of bad bosses that I'll probably have to write a book about someday, and then ended up in a position where my last one committed fraud. So I went on my own and started my own firm about 12 years ago. So here we are, and I've been helping companies to strategize and figure out what the best thing to do is with their employee retirement plans since that time.
Awesome. Wow, it must be difficult to have worked for somebody who was committing fraud. I mean, that's too close to home, maybe even threatening your own personal security and family security. So, uh, totally understand that it was time to jump ship, and why not go out on your own, do your own thing. So, just to put it in context, I want to understand where you sit in the landscape of, you know, 401k retirement specialists. If I have a business and I'm interested in starting a retirement plan, I know about the big names in the world like Fidelity and Prudential, and there's another Guardian, or I don't know. There's a bunch of those like Principal. Um, where how are you head to head with those? Are those your competition? Like what or do you kind of come in and advise the company, but ultimately the plan is being housed on one of those types of platforms?
Yeah, when you talk about the different, we name off those different logos. Those are actually our partners. That's who we partner with in order to help set up the plan and keep it running compliantly. We work with companies first to figure out like what do you want this plan to do? Why do we have it? Of course, one of those things might be that they're throwing off loads of cash and they have a tax problem, right? Or maybe the business owners want to sock some more away because they've invested so much in their business. Or it's they're giving back to their employees. And then from there, once we figured out what we want it to do, then we go out and we look at different providers in the marketplace who are able to support those different plan designs, and also appeal to their employees in a meaningful way and give them tools and resources to be able to do some planning.
Okay, so I mean, let's start with the questions that are probably the front and center of people's minds. If we have somebody who does not have a 401k yet in their business,
Mm-hmm.
and they're throwing off some cash, and they want to maximize what they can put away, right? So I understand that an owner can probably put away more than an employee can put away in a 401k plan. But in doing so, that might come with some strings attached, like they need to put some money away for their employees too. So when we're thinking about, oh, I want to try to save on the tax side, well, then it might cost me on the employee side. And I know it's a benefit to the employees, so there's benefit there. That's, maybe it's not an cost, but
Mm-hmm.
an investment. But can we start there? Can you explain like what is the owner able to do versus what are the employees able to do, and how do we structure this in a way that the owner can maximize what they want without losing their shirt with 20 employees?
Yeah, absolutely. So, first, let's think of it. Well, okay, let's start with the 401k plan. It has different buckets inside it, right? So any employee can defer up to, in this calendar year in 2024, they can do $23,000 that they can set aside, unless they're turning age 50 or older. If that's the case, they can set aside $30,500, and that's just from their own paycheck going into the plan. But as you alluded to, what the IRS giveth, the IRS take away, right? So the IRS does not want to see that the owners and the people who are considered to be highly compensated, so it's a moving target, but let's say $150,000 or more that they're making, that those people are not using the plan substantially more than those who are non-owners and not highly compensated. So they do this testing at the end of the year with these deferrals that people have put away, and they look at those two groups and how much they've averaged to put in. And then if that spread is too big between what the highly compensated have put in versus what the non-highly compensated have put in, the test fails, and you have to either issue refunds or put money in to bring the non-highly compensated up. That's a long-winded explanation, but that's basically what the non-discrimination testing is doing. The second bucket
All right, before
is,
we go to the second
oh,
bucket, I
okay.
have a question on this non-discriminatory testing because
Yeah.
I mean, if we think about it, if somebody's making 150,000, then maybe they can afford to put 20,000 away, right?
Mm-hmm.
Somebody's making 40,000, uh, they maybe can't afford to put much away and they're putting in $2,000, $3,000. So
Yeah.
if you have, if you're, I mean, we're talking about law firms, right? So let's say I have a law firm,
Hmm.
I've got 8 lawyers, they're all making over 150, right? So those
They
eight
sure are.
lawyers are all maxing out their 23,000. And then I've
Hmm.
got a dozen support staff.
Yep.
And those 12 people are only putting in, they're earning an average of 60,000 a year, and they're only putting in $4,000 or $5,000, if that, into the 401k. In that scenario, in that scenario, are we setting ourselves up for a problem? And then how much are we talking about the company needs to cough up to kind of solve that, rather
Yep.
than giving people refunds? Because refunds is, nobody wants to do that, right?
No, nobody wants that. So that ends up where we're going with bucket number two is employer contributions. So with the IRS, they say if you'll just agree to a certain type of plan design where you're either giving everybody 3% of their pay, whether or not they contribute, or you're matching them dollar for dollar up to 4% of their pay, um, then you can get out of the non-discrimination testing. So when you are thinking from a compensation standpoint about that support staff, that's going to be an important part of that equation, that conversation, right? Of how you are putting together their benefits and their compensation. So that's something to think about. But that allows everybody to be able to contribute whatever they want to the 401k plan. And then on top of that contribution, then there's still some more room. There's still some more room for putting more employer contributions in. And that's where you can reward the rest of your employees with what's called a profit sharing contribution. And people like you, as the accountant at the end of the year, who say, hey, you've got this left over. What do we want to do with it? That could be one of the things that you think about. But the maximum amount that anyone can put into a 401k, once you add it up, the employer contributions and the employee contributions, is $69,000.
Now, can there be a discrepancy between how much the employer gives to themselves as the owner versus to other employees, or does it need to be equitable amongst all employees?
Yeah, so there's a couple of different options for how you can structure the profit sharing. You can factor in people's ages. You could factor in their salary amount. You can also look at everybody and say, we've got $10,000, let's split it equally among everyone. So there are different ways that you can reward different subsets of employees differently in some circumstances. So that's going to require the help of some knowledgeable people who are going to help administer the document and do that non-discrimination testing to make sure it still is good with IRS limits.
Okay, so I mean, let's say I want to, as the owner, I want to max out my 60 something thousand dollar capability, right?
Mm-hmm, mm-hmm.
Um, and I do that. Is there a way to structure it so that everybody else is getting a dollar for dollar match up to 4%, and then I'm paying myself the extra $40,000 and I'm okay. I'm in the clear. I'm in the green.
I don't know if that would be quite that big. um, there is a chance that the ownership could put some in for themselves without having to give any more to the others. But I hesitate to say that that would work, that what you described would work and pass.
Okay. So I mean, let's just stay here for a moment.
Okay.
Okay. I mean, this is real world, right? I mean,
Hmm.
some of our listeners maybe are not in the position to do this, but some of them maybe they are.
Hmm.
Um, and these are real questions that they want to know, right? Like, I want to max out what I can, and I want to know what is it going to cost me to do that.
Hmm.
So if the dollar for dollar match isn't sufficient,
Hmm.
right? I need more than that. So if I wanted to max out my whatever 63,000, I think was the amount you gave, that
69. Yeah.
69,000 I'm
Yep.
allowed to put in,
Yep.
then, and 23 of it is my employee portion, I'm assuming, and the other 46
Hmm.
is the profit sharing that's going to me. So what do I need to do in order to make that kosher
Hmm.
for the rest of my employees?
Yeah, there are a couple of things to be thinking about. One is that you're going to have different subsets of employees. So you'll have some maybe who are equity partners, and maybe you'll have non-equity partners. And maybe you want to reward them differently from a compensation standpoint anyway. One thing that's important to know is that the IRS really doesn't care if you discriminate against the highly compensated people. So you could select a group of maybe some of the non-equity attorneys or vice versa that you don't necessarily want to get a profit sharing contribution. You can also look through and say, well, what's the maximum we could give to the owners without having to give anybody above that amount? And so, perfect example for you, we have a client that's a small law firm, 15 employees. They did zero for everyone else except for the main owners, and they were able to put in, I think it was like an extra 6,000 each into the plan. Now, there was another scenario that we ran, which was to say, okay, what if we give the equity partners something, the non-equity partners nothing, and then the support staff some extra because they really worked hard this year. So there's different ways that you can look at the different groups of employees that you have and just keeping some of that stuff in mind. And once you've graduated above the profit sharing, once you've kind of maxed out what you can do there, if you're still looking to save more money, you could start a tandem plan called a cash balance pension plan. This works a little bit differently, but you might have a little bit more flexibility with some of the coverage on it. And if you know from a predictable profit standpoint that there's an amount of money that you're going to want to put aside every year for a tax advantage situation, then that might be another plan that you could incorporate. And those two plans will be tested together.
So that other plan, the cash balance
Mhm.
pension plan, um, is money that's put in there a reduction to income for the business?
Yes, it is. Mhm. Yep.
Very interesting. So I'm going to just go on a small tangent here for our listeners. You may or may not be familiar with QBI and how that affects you as an attorney. But in 2017, President Donald Trump at the time pushed through a bill called the Tax Cuts and Jobs Act, and it was a fundamental shift in the way that the tax landscape looks for small business owners. Essentially, what happened was he wanted to do a flat tax for corporations at 21%. And in order to not leave non-corporate business entities in a poor position, so talking about S corps, which are pass-through entities, partnerships, pass-through entities, or any Schedule C filer where you file your business on your personal return, all of those people are taxed at their personal rates. Personal rates capped out at, I think, 39% at the time. And corporate was 21%. So it wasn't fair to those small businesses. So what they came up with is this thing called QBI. QBI basically qualified business income deduction takes the income that you're reporting from the business and takes 20% of that in a very simplistic form. It's quite complex, but very simplistic form. You take 20% of that total income and reduce the business income before you calculate taxes. To kind of take the bite out of those higher income tax brackets. Problem is that when they created that, they also created the designation of a specified service business. So these SSTBs, specified service trade, I forget what it stands for. Basically accountants, doctors, lawyers, all included in that category. I guess what they were trying to avoid is everybody who's in a highly paid profession where you can basically be working at one place and just say, okay, instead of paying me a paycheck, I'm going to start my S Corp and I want you to pay my business and you're my client, and essentially funnel their paycheck through a business to avoid paying the full personal income taxation and getting that 20% reduction. So to avoid that from happening, they set this cap on SSTBs. So if you're a lawyer and you're married filing jointly at 400 something thousand dollars of income, your QBI falls off a cliff. Basically, you lose it completely. So these conversations where we're trying to reduce the income of the business, they're much larger conversations than just trying to reduce your income tax.
Mhm.
because we're also trying to find ways to avoid the cliff of QBI. We're trying to avoid you losing that QBI deduction. So just a little tangent to give a little bit of color on how important these conversations are. And obviously, from the little bit we've covered so far with Courtenay, it's quite complex. So I'm assuming Courtenay at the end of this episode is going to tell us how to get in touch with her, and whether it's her or another planologist. You definitely want to consult with somebody about your specific situation. You're going to get a level of information here, but there's nothing like getting the specific information for your business. And you definitely want to have a meeting and talk about your situation. Maybe today you don't have those gobs of income coming in, but maybe you're working with Profit with Law and you have us in you're in our coaching program or you're in our fractional CFO services, and we're getting you from a 10% profit margin to a 40% profit margin. And within the next 12 to 18 months, you're going to have gobs of cash, right? So you need to have those conversations and start thinking about what is the right way to structure this. So really like that, Courtenay. Let me ask you this. Is there something that we can do with the profit sharing to kind of and maybe incentivize people to stick around and keep them from leaving? I think the term they call that is golden handcuffs.
Yeah, that's a nice one. So you can place a vesting schedule on profit sharing contributions, and that vesting schedule can be different than that mandatory match, or as we call it, a non-elective contribution. The amount that you're giving to get out of doing the non-discrimination testing. And so if you're in what we call the safe harbor plan to get out of that non-discrimination testing, that's got to be 100% vested. A person could leave your firm tomorrow and they would take it all with them. But the profit sharing is not that way. You can set a vesting schedule up to, let's say, 5 years, where they're earning ownership of it over time. So the longer they stay to work with you, the more they get, as the more they own of the contributions that you've put in on their behalf, and the more they have for retirement. So it is a little bit of something to keep people around with. I wouldn't say it's necessarily the one reason they will stick around with your firm, but it definitely helps when you explain the benefits package and you look at the overall value of the benefits and the compensation that an employee is getting.
Yeah, no, nobody wants to keep a bad employee around, right? But
Nope.
good employees,
Mhm.
it's always a concern for business owners that they're going to be wooed by some other offer, some better offer somewhere else. So we always want to think about when we're developing compensation, and we want to be really, really generous with them. We also want to find ways to allow that generosity to work in our favor by encouraging them to stick around with us a little bit longer. So that question, that response with the vesting, is that a
Mhm.
one-time vesting? In other words, after 5 years, they're vested, and all matches moving forward are theirs right away? Or is it something that every year the amount of profit sharing that we're doing with that employee in their 401(k) plan, that amount can vest 5 years later?
So it's based on their date of hire. So if you say we've got let's say a 3-year vesting schedule, once that employee has worked for you for 3 years, anything that goes into the plan would be theirs immediately. They're vested in it immediately. They own it all. So it's really just the first 3 to 5 years, or however long you're setting that vesting schedule, where it matters the most. But the long-term employees are typically the ones who are fully vested and are going to receive, the full benefit of the contribution you're putting in on their behalf.
What about setting up a non-qualified deferred compensation plan? Um,
Yep.
what if we use that to, and very specifically, like if I have highly paid attorneys, right? So, um, I'm paying my attorneys 30 or 40% of the revenue that they're generating,
Mhm.
um, and they're being paid really well. Is there a way to earmark some of their income into a vehicle that we can basically release to them later, and kind of tie up some of that income?
Right. So non-qualified deferred compensation plan would be a great place to do what you just said. It's discriminatory by nature. can only cover, let's say, 10 to 15% of your employees. It's got to be for like management or, important key employee kind of folks. You can set this up in a variety of ways. We do not have enough time on this podcast to go into all of the different options you have available, but generally speaking, it's started for several different reasons. One being that a person mathematically maybe can't save enough in their 401k plan for whatever reason. They make too much or they waited too long to save, something like that. So you're helping them accelerate what they'd have available in retirement. For others, it's really about lowering that taxable income and spreading it out over some future years. The third would be more of like a quasi ownership experience. If you meet these metrics, then we will reward you with, this amount of compensation. And that's where you can start to see the rolling vesting schedule. Like every deposit may have a different vesting schedule, or there's certain ages or certain targets that are set up for when it vests in the future. So yeah, it's a little more the Wild West. The one thing to keep in mind is that any money that's put into that has to be substantially at risk. And what that means is if the firm should go out of business, it would be subject to creditors. So that's the way that the IRS lets this type of plan be allowed. And the other thing too is to think about, and this is where you come in as the valued person with the tax side of things. How does that affect their taxable income now and then in the future? Because if it's an S corporation or a pass-through entity of some type, then you may not see the tax rewards, I should say, until that employee has that money in their hand, and that's not until the future. So when they take constructive receipt. So there's lots of things to think about there, but I love the idea for sure that you brought up.
Yeah, so this is not going to be an effective tax strategy for you as the business owner, because essentially when you first implement it, you're going to be raising your income on paper for the business, because the money that you're earmarking for this type of plan, as Courtney just said, is not an expense to the business until it's paid. So if you have a 3-year vesting period, that is now going to start coming out 3 years later. On the flip side, when you do start paying it, then it'll ultimately catch up to itself. So it's a temporary gap. But what it does is I mean, let's say that I think that an attorney should be making 20% of the revenue they're bringing in, and if I'm giving them 30%, that extra 10%, we can put that into this type of plan with a vesting period. And now, let's say they earn $200,000 this year, so that then another $100,000 would be in this deferred comp plan. Fast forward 3 years later, when that $100,000 starts to become available to them, they now have another 200,000 or 300,000 sitting there waiting for them. So this idea of golden handcuffs, if you want to give people incentive to stick around, you can be very generous with how you pay them, and yet they haven't received it yet, so they know it's coming. So they have the recognition of the reward, but they don't actually have it yet, and that they would have to basically be saying goodbye to that money if they were to leave the company. It's a really interesting idea to play with. All right, going back to your primary wheelhouse, where where you
Yeah.
probably are want us to swim. When it comes to 401k plans, one of the hesitations I hear from business owners is it's very complicated, right? There's all kinds of forms and things that need to happen, and it needs to be audited, and and it needs to be checked for this discrimination check. What First of all, is that something that someone else can handle? And then second of all, can we define how much risk the business owner is taking by establishing a plan, when there's a possibility that they might not meet some of these checks and balances at the end of the year and need to do something about it, which might cost them some money?
Those are all great questions. When you go to set up these types of plans, it's important to know that you do have, as the business owner, or whoever's the official person in charge of this plan, you do have fiduciary responsibility. So if you can just take the approach of, this is my grandmother's money, I need to treat it respectfully and make good decisions on her behalf. And I need to have a slow decision-making process where I'm I'm writing down why I'm doing what I'm doing and how I made the decision, what the process was. That type of approach will keep you out of trouble 9 times out of 10. Hiring, obviously, an expert like us to come alongside you and be that navigator, that's going to be very important as well. So our firm will take the investment liability. So we'll be there to select and monitor the plan or the investments in the plan. We'll also be there to keep you out of the employee conversations like, oh, well, how much should I put in this plan? Where should I invest the money? What should I do with it? So that's where we come in to help take that liability out and keep those conversations out of the HR office if possible. So the other thing is the Department of Labor and IRS have, like you mentioned, some things that you have to do, these responsibilities of sending out notices or making sure that your plan is tested at the end of the year and all the compliance information is done. The tax filing is called the Form 5500. And so what you want to do is lean on your vendors for a lot of that and making sure that you've got your responsibilities written down, which generally are you've got to make sure that the money gets from payroll to the 401k record keeper, whoever's holding on to the money, timely. That's the biggest one. That it's separated from the business assets as soon as it can be. Beyond that, it's making sure that your employees know about the plan and that they can enroll and that you enact their instructions just like the plan document outlines. So those are the main things. But having good partners around you, just like you surround yourself with a good accountant and a good, attorney, and you hope your clients surround themselves with good attorneys, it's the same kind of concept here.
Yeah, and the concept of fiduciary responsibility is not a new one. We're talking to attorneys who have trust accounts. They're handling client funds all the time, or at least many of them are. It's kind of the same level of obligation when you're dealing with the 401ks because technically it's their money, right? Like it's your employees' money, so you don't really have a right to it. There are other types of plans. And so a solo 401k is for a business owner before they have employees, which is really, really easy to implement. But then the moment that you hire an employee, you no longer can have a solo 401k. So you're automatically
Yeah.
pushed into this more complex 401k bucket. But there's also SEP IRAs and simple IRAs, right? So
Mm-hmm.
um, I, I don't want to go into, we don't have enough time to go into a whole explanation of what each of those are. Suffice it for our listeners to say that they're way easier to administer than a
Way easier,
401k,
way less
right?
expensive.
Yes. So here's the question. If I'm just looking at the size of a business, right? At what size does it become too cumbersome or too much to be using a SEP or a simple and a 401k is a no-brainer? Like, where is the cutoff? And I know it's not a magic number, but can you give some guidance to our listeners on as you grow your business, probably, you should start with a SEP or a simple and then go to a 401k at this level. Is there any sort of guidance there?
So the SEP or the simple is going to be a great product. It doesn't have the same level of fiduciary liability. The 401k is obviously more expensive to administer, and it's covered under the Employee Retirement Income Security Act. For our ERISA attorneys out there, you are my people. So I wouldn't say it actually has anything to do with the number of employees, because 100 or less, and you can still do those two that we just said, the IRA products. What I think you should be thinking about is, what do you as the business owner want to save for your retirement? And is it that higher amount that we mentioned before? Because SEPs and simples, you may not be able to save as much. The simple caps out, it's got a limit that is tied to inflation, and I think it's it's $16,000 for 2024. So if you want to save more than that, or your employees who you're trying to attract and retain want to save more, that's when the 401k plan becomes more attractive. And then the second piece is, do you want to have more employer contributions going in than what the simple can hold? The SEP, obviously, you can't do any employer contributions into anymore, but you can do some to the simple, which is a 2% contribution or 3% match. So if you're trying to put more aside or do some of those profit sharing things that we were talking about before, where you have a tiered system for how people are receiving it, et cetera, that's going to be found in the 401k. And if you're trying to be that complex about it, then it's worth paying the extra amount and it's worth the extra headache that goes with it. Does that help?
Awesome. Yes, it
Okay.
does. It does. And clearly these are more reasons why you want to be meeting with somebody like Courtney to really discuss all of these nuances. Like, what do you want? What do your employees want? What do you think your
Mhm.
employees want? Or what do you want to make available to them to help attract the right people? I mean, we're in a job market today where it is extremely difficult to find good talent, to hire good talent, and I mean, you need to pay them well. And it's not just the
Mhm.
compensation they receive, but it's the benefits package you're offering. And as small business owners, I mean, most of our listeners are really small, right? So, um, as really small business owners, it becomes really hard to compete with those larger entities that are going to take your people, your potential hires, and give them all kinds of things like, medical benefits. And, so when they're looking, they're like, oh, I want it to have a 401k. I want it to have a certain match. You can potentially be increasing your worth in the eyes of the beholder when it comes to employees who are thinking, potential employees who are thinking of coming to work for you.
Yep,
Uh,
great point.
Courtney, we have a little bit of time before we close out. So instead of me asking you a question, I'm going to ask you this. Is there any question I didn't ask, anything that we didn't cover that you think is really important for our listeners to know when it comes to any part of your phonology?
I think the marriage between the retirement plan and the taxes is really important, and that's where your accountant is your best friend. I've heard some say, well, you either pay yourself or you pay the IRS, and that's not necessarily 100% true. But as you mentioned today, with some of the qualified business income, et cetera, there's so many different loopholes and so many different things that you just have to keep in mind when it comes to these plans and what you're putting aside and what you get in return for it. So from an outsider's perspective, it's so easy for me to say, well, you get the chance to save a bunch of money so that later in life, you don't have to go and work for anybody to get a paycheck. You have the freedom to decide how you spend your life at that point. And you don't have to, it's not tied to the value of your business. It's a separate line item. But for others, that recruiting piece is super important. How do we get the good attorneys? How do we get the good talent over here, the good support to help our firm grow? How do we reward them if we do grow? So all of those questions are really important. And then how does that affect the taxes? It's not going to be a dollar for dollar offset, but you are going to be rewarded for helping out your employees in a meaningful way. So I think all of those things are very important to keep in mind. And just hiring the right people, surrounding yourself with the right people. Any financial advisor can come along and say, oh, sure, I'll set you up a 401k plan. But where we differ is that we are specifically in that arena, having those conversations with the tax accountant, knowing exactly what we can do and what we can't do in those types of plans, rather than having a practice that just kind of accommodates them. So I would say get good help. That is the most important thing you can do as a business owner.
Yeah, I love it. And I think it's worth going over this idea of profit sharing. I'm a big fan of creating a profit sharing plan, nothing to do with 401ks, for
Mm-hmm.
your business, right? Like, I mean, if you are operating at a healthy level, and we're talking about 30 to 50% profit margin, if it's less than 30, then you probably don't have the wherewithal to do this. But if you're tracking above 30% profit margin, and you want your people to feel loved and appreciated, then it makes sense to create a profit sharing plan. Now, we can do hours of podcasts on just how to structure that.
Yes.
But the one idea that I really like is if you create a profit sharing plan to take a piece of it, and I'm not talking about the whole thing, but take a piece of it and earmark it to be profit sharing in the 401k so that when people are getting a bonus, they're getting a bonus that they can get now, but they're also getting a bonus into their 401k where you're they may some people may need the cash today and may not appreciate that, right? But
Mm-hmm.
most
Mm-hmm.
who are trying to at the same time they're trying to live and trying to live their life are also trying to save for retirement. You're going to give them a boost that they may not have done themselves. They may not have said, oh, earmark X amount of my bonus into my 401k. Instead, they're not getting a choice, right? Like this is just we're given X amount of dollars in our profit sharing, and 25% of that is being distributed through the 401k. Same difference to you from an expense perspective. They're both going to be deductions to income, but you're also helping your employees in another way. I really like the idea of thinking of it that way and doing it that way. For the people who need it right away, most 401k plans they can borrow against, right? They can take a loan against it. So if they really need the money, they'll have a way to access it. Not a big fan of encouraging them to do that, because if they leave,
No.
then they need to pay it back. It's a distribution. They lose 10%
Yeah.
plus income taxes on it. But it is, you don't have to feel like you're setting them up in a way that's not fair to them. But I really like this, if you start thinking of profit sharing, to even add these two buckets to it of, a cash distribution and a 401k distribution.
Yep. You're helping today you and future you for all
Yes.
the employees.
Love it. All right, Courtney, we're going to wrap up. So real quick, I'm going to give you two things I'm going to ask you for. First,
Mhm.
one parting piece of advice for our audience. And number two, how can they find out more about you, get in touch with you, take a next step with you if they really enjoyed this conversation?
Parting wisdom, I'm going to go back to hire good advisors. Upgrade your advisors when it's time to, if you need to. The other thing, where you can find us. So I'm on LinkedIn, C. Shipley. You can also find us at retirementplanology.com/learn more. We've got a great blog on there too, if you want to cyber stalk us, and that's a good place to start.
Awesome. Thank you so much. We're going to link that up in the show notes. So, folks, if you're in a place where you can't write this down, you're out for a run, you're driving your kids to school, you're in the shower, whatever you might be doing at the time you're listening to this podcast, we've got you covered. Go to profitwithlaw.com or the description in your podcast player. All the resources, including the links that Courtney just gave you, are all going to be there for you to just click on at your leisure when you're ready. We're here every single week with a new episode. We love having you as a listener, but you can help us grow our audience. And the way you can do that is by leaving us a rating and review. So if you could take a moment and just go into your podcast player and hit that button to leave us a rating and review. Doesn't matter how many stars, doesn't matter what you say. We'd love a nice one, but we want your honest opinion, because people are going to come and check the show out. And when you want to figure out whether you should do something, you're going to check out what other people are saying about it. They're going to do the same. So help us by spreading the word of the podcast by simply leaving us a rating and review. Thanks. That's all. We'll see you next week.
Thank you.